Today I want to talk a little bit about the value investing. The basic concept of value investing obviously is many decades old. But today I think it is as relevant as when it was first laid out by Benjamin Graham at Columbia 6-7 decades ago. There's essentially just three basic ideas. The first one is that stock is not a piece of paper that you trade, but is a representative fractional ownership of a company. And therefore, valuing a stock ought to really have a basic variance of valuing the company as a whole. And then secondly, that in valuing any financial asset, that you have to really predict the future, the discounted cash flow of the future cash earnings. And the future is inherently difficult to predict. And therefore, you really want to leave yourself a margin of safety so that you could be wrong or you could be right. But because the future is a distribution of opportunity, with statistic possibilities, say you bet on something that at 90% of the chances you could be right, but then a 10% chance occurred, and so all of a sudden it become 100%. So you want to leave enough of margin of safety. In other words, you want to buy at a low enough of a price, even if all the adverse events occurred against you in the future, you will still be in the game. It doesn't mean you won't lose money, but it just means that you will not lose so much that you'll be out of the game. Because investing is really a long game. It can play it over the life of anybody's career. And so you want to be really in the game somehow over the long haul. And the third concept is Mr. Market, to figure out a frame of mind to think that when the market is against you, you can really look at it as a neurotic Mr. Market that's prone for emotional and irrational behaviors. So those are the three basic concepts. At the heart of it is obviously it is this bargain idea that you want to really get what you pay for.